We're going to come on now to our first insight session. It's about investment and funding. It's with Burges Salmon. And it's really around on what terms should an ambitious entrepreneur accept funding, what perhaps are the common pitfalls and smart pieces of advice. Here on screen in front of us within a nanosecond is going to be Alex Lloyd, the director of the firm's corporate team, talking from the perspective of founders on investment terms. Alex, it's yours.
Thanks very much, Greg. Greg, I'm having some difficulty sharing my slides here, actually. I don't know if there's...
We have backup, and I'm looking at our team upstairs. You go, and if it doesn't work, we can interpolate. I'm saying that with great confidence. I think we can. Let's give it a go. You start. Let's see how far we go, and tell us about investment term sheets advice for entrepreneurs.
I'm talking with no slides at the moment, but that doesn't matter. So you heard from Chris and Greg, and you had George Bernard Shaw quotes. You had talk about belief, resilience, determination, and all that great stuff. So my job is to bring you all right back down to earth. And as Greg said, I'm a director in the corporate finance team at Burges Salmon. I'm a member of the venture capital and private equity team and the tech and comms specialism. Before I get into anything, I've got a shameless plug to make. So we've got an initiative launching in September, which is called B-Scale. And B-Scale is a lot of things, but in part, the major part of it is a suite of automated documents that will be available for free to enable startups and scale-ups to operate, but also to raise their first bit of capital. So there'll be some free subscription and shareholders agreement, free articles, employment contracts, website terms, and a whole load of resources that go along with those, and guidance notes on things like R&D tax credits, EIS, etc. So that's coming out, and along with it, and probably the most important bit, is some pricing options that we're trying to put together to try to ease that burden of legal costs for early stage companies and entrepreneurs. So that's coming along in September, and I'll stop plugging now. So what am I talking about? So we're talking about investment term sheets, and we're talking about it from the perspective of founders, management teams. And the idea is to try and leave you with some concrete facts, basically some concrete things that you can take away. And when that term sheet lands on your desk, you've got something to use to negotiate with, and to be practically useful. So if you turn to the first slide, please. Let's start with the basics. So why do you have a term sheet? And they can take lots of different forms, of course. You could have, it depends on who the investor is. If you've got a VC coming in, it's going to be different than if you've got a high net worth. If you've got an American investor, they're going to have different requirements than a UK investor. So all I can do here is talk generically, of course. So why do you have one? So you've got to focus on the key deal terms, and you're trying to create a roadmap for drafting your key documents. So you're going to, whatever's put in this term sheet in summary form will get drawn out in long form documents in an investment agreement, some articles, some service contracts. When do you do it? So you're going to put the term sheet together when the terms are clear enough, of course. You can't codify something unless you know what it is. And the second point on timing, which is we're going to come back to in a second, you do it when you're prepared to speak exclusively to an investor. And that's going to be very important, and we're going to come back to that, as I say. The whole thing isn't binding. There's only 3 provisions in the term sheet that'll be binding, and those are usually the exclusivity, confidentiality, and cost provisions. But what it does create is a moral obligation. You don't want to be reneging on things you've agreed at the term sheet stage. So we can move on to the first point, the first takeaway, which is really an obvious point to make, but it's one that's really worth making, and one that's been brought home to me because of some recent experiences. So I've been running two transactions in parallel over the last couple of months, both of which we're acting for the company, trying to raise money from major UK VCs. And there was a contrasting approach taken to term sheets by each of those sets of founders. The first set of founders took their time on the term sheet. They asked for clarification. They pushed points at the term sheet stage. And they did it before they signed, so before they'd given away exclusivity. So they used that leverage, and they drove themselves a better deal, and they had more clarity going into the long-form documentation stage. In contrast to that, another set of clients didn't involve lawyers at term sheet stage, didn't push, and actually signed up to a term sheet that they didn't fully understand, including some of the key economic terms. And what happens is you then get served up a set of documents which are clearly going to reflect the term sheet, be investor friendly to start with. And we've been then trying to row back from that bad starting point from then on in. So the first point is an obvious one, but I think an important one. Don't rush in. Use, if there's competitive tension that you can use it. Don't give away exclusivity too soon. That's point one. Second slide, please, which is about warranties and liability. So if you flip onto the fifth slide in the deck, please, whoever's controlling the slides. So investors coming into the company, and they've valued the business and they've conducted some due diligence, and now they're going to ask for some contractual statements and promises that allow them to verify that valuation and that diligence. And they'll ask the company and the founders and the management team to give these warranties. And we're not talking here about the company. The company's liability will be capped at the amount of the investment almost always. We're going to talk about the personal liability of management. Before we get into it, worth talking about the core principles that are at play here. So management's liability will be capped at something like 1 or 2 times salary. So it's not a mechanism for the investor to try and recover, really. This is all about focusing minds and driving the founders and the management team to disclose properly. Anything where those warranties are untrue, they're going to talk about, they're going to tell the investor through the disclosure process. So this is what it's about, focusing minds and driving disclosure. And if you think about what it would mean for the investor to sue its own founders, to sue its own management team, that would be suing the very people that are delivering value, that are delivering the business plan. So it really is a nuclear option. So it's worth bearing those principles in mind while we're talking about warranties in general. So what are they? They are contractual promises, they're statements. So let's go through the various types that you might be faced with. So a fundamental warranty might be, I have the capacity to enter into this agreement. An operational or business warranty, those are things about the business itself. The company owns all the IP. The investment warranties are a slightly different category. So you'll be preparing a business plan and there'll be DD reports produced in connection with the investment. And those types of warranties will be things like, we diligently prepared the business plan, the assumptions on which we believe in the assumptions which underlie it. The DD reports, you might be saying the factual information in those DD reports is correct. You'll also be asked to fill in a questionnaire, which can ask some quite prying questions about your financial well-being, about your physical health. Have you been bankrupt? What are your other business interests? And you'll be asked to warrant those. So the takeaways in terms of management warranties, the most crucial one and the obvious one is disclosure. So provided that you say where a warranty is untrue and you give enough detail and you're specific enough, you're going to qualify that warranty. It's going to mean that there can't be a claim for breach of warranty. So doing a rigorous disclosure process is crucial. Second takeaway, remember these warranties are about the state of the company now looking backwards. They're not forward looking. So you're warranting the state of affairs as they exist. You're not warranting that what's going to come true, what's going to happen in the future. It's about facts and not forecasts. The business plan warranty is the key, is an obvious example here. You warrant that the assumption that you believe in the assumptions and that the thing was diligently prepared. You don't warrant that the business plan is going to come true. Knowledge qualification is the next one. So remember I said that really when we're talking about warranties being given by management, they should be focused on focusing minds and driving disclosure, not about recovery. So there's quite a good argument to say that we should be giving some of these warranties or lots of these warranties or all of these warranties so far as we are aware. There's a very big difference between giving an absolute warranty and saying, so far as you're aware, X, Y, and Z is true. The boring bits, financial limits, usually set at 1 or 2 times salary. It's about putting enough jeopardy there that you're focused. It's not about ruining you financially. Time limits, usually between 1 and 2 years, or an audit cycle for non-tax warranties. We can move on to the next one now, please. Which is all about what happens if you leave the business. And if we flip on to the first slide with the detail on it, it's talking about leaver provisions or compulsory transfer provisions. And next slide, please, guys. So what we're talking about here, what are they? So if you leave the business, if a manager or a founder walks away from the business, they can be compelled to sell their shares. That's what this provision deal does. And the manner in which you leave the business determines the price you get for those shares. So it determines the value that you receive. And again, let's talk about the principles that underlie it. So the investors backing the management team to deliver the returns. So they need you to stick around. They don't want you to leave, of course. And these provisions provide the incentive or the disincentive to stay in the business. The other core principle is if somebody walks away and they're holding a chunk of the equity, that equity is useful. It's useful. It needs to be recycled. It needs to be used to incentivize whoever comes in to replace the leaver. And the last principle, which is worth just touching on and bearing in mind, is that you could be the founder that leaves, or you could be the founder that stays. If you're the founder that stays, you're in the same boat as the investor. And so it's quite easy when you're negotiating these term sheets to slip into this mindset of, oh, it's investor versus founders and everything becomes adversarial. But there's lots of places where there's alignment, and this is one. I'm going to talk about the takeaways in a second, but I think it's worth flipping onto the next slide first. And on that next slide is a table which shows you some examples of leaver provisions. And these can be, there's a whole range of things you could have, and these are just some examples to give you a flavor of what these constructs might look like. And we'll take the top row first. So we're talking here about an investor-friendly formulation, which is, and sometimes when you present these things to founders, there's a deep inhalation because it all sounds a bit brutal. But rest assured, this sort of formulation does exist in the market, and you do see it. So in this example, you're a good leaver if you die or you're critically ill. Which sounds awful. And in that scenario, you're going to get your fair market value back. You're not going to lose any value there. Everything else, you're a bad leaver. And you can imagine there's a whole load of gray areas there. It's not just, serious malfeasance or cause. You could easily slip in. If you have this formulation, you could become a bad leaver in lots of scenarios. And there, the outcome is draconian. You lose all your value. The price payable is the lower of the issue price, so the price you paid when you first subscribed, which is likely to be very little, and nominal value, which is likely to be £1 or a penny or 10p. So bad leaver, you're losing all value. And in the far right column, you see in this formulation, that's going to apply to all shares. So everything's on the line, and you've got a very narrow definition of good leaver, so a very narrow set of circumstances where you can get value back. A founder-friendly version in the second row might flip that on its head. So it might say, instead of starting with a narrow good leaver category, it starts with a narrow bad leaver category. So we say, you're only a bad leaver, you only lose value if you do something really wrong. Fraud, summary dismissal, that's dismissal without notice under your employment contract. Breach of restrictive covenant, that means, non-competes, non-solicitation of employees, etc. And everything other than that makes you a good leaver. So you only lose all the value in those narrow circumstances. You get fair market value in all other circumstances. And you might also be looking there at a situation where a certain number of your shares are completely sacrosanct, so they're held outside of this regime altogether. And that percentage of shares may increase over time, potentially. The last category is sort of something in the middle or closer to the middle. So you've got a slightly expanded good leaver category where you get fair market value. That could include redundancy, could include wrongful dismissal, maybe retirement question. And then a bad leaver category, which is the same as before, talking about real cause, real bad behavior or malfeasance. And then you introduce this intermediate leaver category, which is everything other than good or bad. And that one comes along with a vesting schedule. So if you leave in year one, few of your shares will be vested. Most of them will be unvested. And for the unvested shares, you lose all the value. If you leave, say, in year 4 or year 5 or year 3, a greater proportion of your shares would have vested over time. And for those vested shares, you'll receive fair market value. So that's a sort of a way perhaps to bridge a gap. And if we flip, sorry to keep going on about flipping the slides, but if we flip back to the prior slide, we'll go over the takeaways very quickly. So takeaways. Your term sheet might have very little detail. It might just say typical good and bad leaver construct. It may not go into any detail. So you may want to use this opportunity to push and to work out exactly what's being offered here. Takeaways are, should some of the shares be sacrosanct altogether? How are they looking to set up this good and bad leaver construct? obviously it's better if it's for you, if it's good, if you're not bad, have that broad good lever category, that narrow bad lever category. Is there a difference that can be bridged by using that early or intermediate lever compromise? The next takeaway, and this is quite an important one as well, because the lever categories, as I said before, they interplay with the employment contract, because you're often a bad lever if you're summarily dismissed under your employment contract. So you need to understand what it says in your employment, in what circumstances can you be dismissed without notice, because that'll make you a bad lever. So be careful of that interplay. And the last takeaway is, before you get into this, think about the individual circumstances of your founders and your management team. Are any of them coming up for retirement is the obvious one. So that's good and bad lever. That's the compulsory transfer provisions. So we flip 2 slides on now, please. You'll arrive at restrictive covenants. And these are things you'll be more familiar with, non-competes, non-solicitation of employees. And those covenants usually run for a period of 12 to 24 months after a manager leaves the business. This is another one where the people who aren't leavers are aligned with the investor. You're in the same boat again. And you can understand the core principles here. Clearly, a competing manager destroys value in the business, both for the investor and the remaining managers. You don't want your co-founder going off and starting a competitive business or working for a competitor. The reason I put the slide in is partly because in recent times, I seem to have seen lots of requests for these restrictive covenants to run for the period of 12 to 24 months, to run not from the date that you cease to be employed. People are trying to argue for them to run from the date that you cease to hold shares. And if you think about that, this is a private limited company with illiquid shares. There's no guarantee those shares will be bought back from you when you leave. So you could be subject to a restrictive covenant that runs ad infinitum while you hold shares in the private limited company. You may never be able to get rid of those shares. There's no ready market for them. And that is it could be seen as a slightly innocuous and easily missed point in a term sheet. But if that's the case, you could be locked out of your chosen sector for quite a long period of time and unable to make money. So it's a one that's been slipping into documents of late. The next 2 points are slightly more obvious. Be careful of the scope of these things. What are they actually locking you out of the market from? Is it wider than what the actual business does? Are you being restricted from working and making money? And then enforceability. If these things are too broad in geography or in scope or in time, they just won't be enforceable, because there are restraint of trade laws which control these things. So there's your restrictive covenants. Next slide, and we're getting into the economics, the economic terms now, and we're talking about liquidation preferences or liquidation priorities. So what are they? What is a liquidation preference? So on a liquidation event, and that could be a sale, a winding up, or return of capital of any kind, but let's think about it, when we're talking about it, let's think about it as a sale, because it's the easiest one to conceptualize. So on a sale, you've got some proceeds to be divvied up amongst the shareholders. If there's a liquidation preference, before anyone else sees any of those proceeds, the investor gets its money back or a multiple of its money back. And if it's a 1x liquidation preference, the investor's going to get an amount equal to its investment back. If it's 2x, it gets double its money back. So that's quite simple. And then the next 2 categories are the important ones for the purposes of this presentation. So if it's a participating liquidation preference, you've got some proceeds from the sale. The investor takes its slice first, takes its preference amount first, and then you've got a pot left over at the end. And if it's participating, the investor is going to immediately also share pro rata in that pot. And we're going to go through an example of it, but that skews the upside returns. If it's a non-participating liquidation preference, and there's a couple of ways you can set these up in the documents, which we won't go into, but in effect, it means that you've got your pot of money from the sale. It's got to be divvied up between the shareholders. If it's non-participating, the investor takes its slice first. Then the founders take the next corresponding slice until they catch up, until you're at parity. And then the remainder is split pro rata. So in that non-participating preference, it doesn't skew the upside returns. It provides a downside protection for the investor only. And the takeaways for this, for liquidation preferences, are going to be, it depends on the overall economics of the deal, but usually you can argue that the purpose of the liquidation preference is to provide a downside protection, and that translates into you asking in your term sheet for clarification that they're talking about a non-participating liquidation preference rather than a participating one. In the next couple of slides, we'll just run through what that looks like. So here's your scenario. You got some founders, they've got 100 ordinary shares. They subscribed way back when for £100. The founders and the investor have agreed a pre-money valuation of 200 grand here. Obviously, we're using daft round numbers. They're putting in 200,000. You've got 100 shares, gives you a per share price of £2,000 per share. And the investor's subscribing for 100 preferred shares at that £2,000 per share price. So using that scenario, if we flip onto the next slide, it'll give you an example of how the liquidation preference works. So we've got two scenarios. We've got a £200,000 sale, which is a bad outcome. The investor put in 200 grand and the whole thing is being sold for 200 grand. And on the far right column, you've got a £1 million sale. So there's some proceeds to go around. That's an upside scenario. Remember from our scenario just now, both the investor and the founders hold 50% of the shares. They both got 100 shares. So absent a liquidation preference at all, the proceeds will just be shared pro rata 50-50. So in your downside scenario, 100,000 to each the founders and the investor. On our 200K downside scenario, the outcome, whether or not it's a participating or a non-participating liquidation preference, is the same. You've only got £200,000 to go around. The first slice is always going to go to your investor because of the liquidation preference. And here, that first slice is 200 grand. So on your downside scenario, the liquidation preference does its job, protects the investor. They take the 200 grand. There's nothing left over for the founders. The more interesting one, and the one that shows the difference between the participating and the non-participating liquidation preference, is on the upside, on that £1 million sale. So let's look at the participating preference first. This is the one that's going to skew the upside. So if you look at that row, which says 1 times participating, you've got £1 million to go around. First 200 grand goes to your investor, leaving you with an £800,000 pot. And because it's a participating preference here, the investor is going to share pro rata in that £800,000 pot. So the investor takes the first 200 and then 50% of the 800, leaving it with 600,000. Your founder, on the other hand, is left with 400,000 because the first 200 went to the investor and the founder's pro rata share is just taken from that 800. So the upside is skewed. The investors come out much better off in a good event, in a £1 million sale. Whereas if it was a non-participating preference, first 200 to the investor, second 200 to the founders as a catch-up, leaving you with 600 to be split 50-50. And the outcome there is the same as if no liquidation preference applied at all. The upside not skewed. So the takeaways from your liquidation preference, provided that the overall economics work makes sense here, you say this should be a downside protection only, specify in your term sheet that it's a non-participating preference. That brings us on to preemption and anti-dilution.
On to that, could I just say we are running a little short of time, so thank you.
Oh, no problem, Greg. I will accelerate. So what is preemption? What is anti-dilution? So preemption is the basic way in which a shareholder protects themselves from dilution, and it's the right to subscribe for your pro rata percentage of any share issues. In effect, we're saying if you don't want to be diluted, participate in the next round, follow your money, and if you can get away with that, then fantastic. If the investor is not pushing for any more anti-dilution protections, then great. Basic preemption right is the way to go. Follow your money, please. If not, and you end up in a situation where there's investors asking for anti-dilution protection, what they want is a formula to apply, and that formula is going to apply in a down round situation. So where you issue shares for less than the seed investor paid, a formula will kick in and that'll offset the dilutive effect of the down round. I was going to run through an example of how this works, but if we're short for time, I don't think we need to necessarily, and we could just leave you with the takeaways. And the takeaway on that second point, that anti-dilution mechanism, is you want to specify in your term sheet that the formula that's applied is a broad-based weighted average formula. That's all you need to know, really. Not a full ratchet, not a narrow-based formula, a broad-based weighted average formula. So that's your takeaway. And if we push for time, Greg, I'll leave the remaining slides and just go back and just emphasize some of the takeaways.
Please.
So if you remember, our first takeaway was the obvious one. Don't rush in. Use the leverage you've got before you're giving away exclusivity to try and push for some terms in the term sheet. Warranties. Obviously, you're going to do a great disclosure process anyway. But remember the takeaways here. You're warranting about the past. You're not warranting about what's going to happen in the future. It's facts, not forecast. Try and knowledge qualify the warranties as far as possible. The caps on liability should be 1 to 2 times salary, nothing crazy. It's not about bankrupting you, it's about focusing your minds. Think about compulsory transfer and leaver provisions. Remember how we split those categories. Ask for some clarity. What are they actually asking for here? Can some of the shares be sacrosanct? Can you have a narrow bad leaver category? Can you use that intermediate category to bridge a gap? Then we talked about restrictive covenants. Be careful about the scope generally, but also be careful that they run from the date that you cease to be employed, not the date that you cease to hold shares. Then we talked about liquidation preferences. The takeaways there were it's a downside protection only if you can, which means that it's a non-participating liquidation preference. And on the whole, it should be 1 times. This is by far the most common. Next, we talked about anti-dilution and preemption. If you can avoid the complication of an anti-dilution ratchet altogether, do and just have a preemption right, just the right to follow your money. If you do have to have one, it's a broad-based weighted average formula that you want. So hopefully, I've had to rattle through that, I know, but hopefully you've come away with something. There's something tangible there to help you when that term sheet lands on your desk.
Alex, thank you ever so much. A couple of points. 1, this presentation will be on the EntreConf site. And 2, Burges Salmon are running a round table at lunchtime, so please follow up with questions. We do have one external question I'd just like to put to you, if we could bring you back on screen. It's from Ned Dorbin, who's asked about assuming the disclosure process is done properly and thoroughly, and it will be if there's profound advice such as you've given. How much risk is a manager facing by signing up to warranties, given there's a potential personal liability of 1 to 2x salary? Alex, if you're with us on that?
Yeah, I'm with you. Yeah, well, as Ned said, if you've done the disclosure process and you've done it properly, and there's appropriate knowledge qualification there, so your warranties, most of the warranties, insofar as you're aware, or some of them at least, then you can be fairly confident that you've mitigated your risk. You've disclosed, and in disclosing, you've qualified the warranties. And the other point, I suppose, to go back to what I said earlier on, if you put the risk in practical perspective, if the investor is going to be suing its own management team, as I said before, it's suing the very people it needs to deliver value for it. And so it's a nuclear option. It's not going to happen unless there's a real reason. It's really gone wrong. So I would say it looks scary. It feels scary. We see very, very few warranty claims where investors are bringing them against management teams. So do your disclosure process properly. Make sure you address those comments that I mentioned earlier. And I think the level of risk is certainly manageable.
Actually, I will slip in one more question. Restrictive covenants, in reality, how enforceable are they, and how often are they actually enforced?
Again, it's strange, and perhaps it's just anecdotally and where I'm sitting, but I haven't seen instances of them being enforced, but I suppose I wouldn't because I'm not a litigation lawyer. They are enforceable, Greg, provided that the geography is limited and the time frame is limited to something reasonable, usually 12 to 24 months in this context. So they are enforceable. They do work. People always ask for them. They're always there. And it depends. I suppose it depends exactly on the sector as well. So, take, for example, a business which is heavily people-driven, and the value in that business is in the heads of the management team. The investor and the rest and the remaining managers are going to be very focused on the restricted covenants and more likely to enforce them than in another situation. So I haven't seen many examples of them being enforced or arguments about them, but I know it's an area of real focus, and they are indeed legally enforceable, provided that they're not overly broad.
Right. Well, very, very good. There's a lot of practical advice there. This, part of the role here is almost negotiating a divorce before you've got the marriage sorted. But it is absolutely essential that grounded, detailed legal advice is given to any entrepreneur prior to entering a term sheet. And Alex and to Burges Salmon this morning, thank you very much for explaining the processes and some of the apparent pitfalls and things to look out for. Thank you.